If you were born before 1961, there is a number sitting inside your IRA right now that decides whether you keep your money or hand a quarter of it straight to the IRS. And almost nobody explains it to you until after the mistake is already made. I want to say that again a different way because it matters. Your birth year does not just affect when you can retire. It quietly assigns you to a specific rulebook for your retirement accounts, a rulebook that is different from the one your younger neighbor is using, even if you both walked into the same bank on the same day and opened the same kind of account. There is a deadline buried in that rulebook. Miss it, even by a few weeks, and the penalty is not a slap on the wrist. It is one of the harshest number in the entire tax code. But here is the part that catches people off guard every single year. Knowing the rule exists and actually following it correctly are two completely different things. The IRS does not call you. Your brokerage does not always catch it either. There is no reminder that pops up on your birthday saying, "This is the year it changes for you." You are expected to simply know. And if you do not, the penalty clock starts ticking whether you noticed or not. That gap between the rule existing and you actually applying it correctly is exactly where thousands of dollars quietly disappear every year. And before you assume this does not apply to you, let me clear up the two biggest misunderstandings I run into, because this is exactly how good, careful people talk themselves out of paying attention to something that is about to cost them. Some people hear IRA rules and assume it only matters if you have a huge account, a few million tucked away, the kind of balance that needs a team of advisors. So if your account is modest, you tune out. Other people hear the opposite. They assume this is only a small account issue, some technicality for people barely getting by. So if you have built up a healthy nest egg, you assume someone else already handles this for you automatically. Both of those assumptions are wrong, and both of them can be expensive. Some of what I am about to walk you through matters more if your balance is modest. Other parts matter more if your account has grown large over the years. On every single one, I will tell you exactly who it affects most, so nobody watching gets to say, "Well, that one's not for me." And if you are still working part-time or you are helping a parent manage their own retirement account, stay with me, because one of these rules bends differently depending on whether you are still on a payroll. So let me tell you quickly why you should listen to what I am about to say. My name is Claire Weston. For years, I have sat across the table from retirees, from their adult children, and from the confused paperwork left behind when nobody understood these rules in time. And I will tell you the pattern that shows up over and over. It is never the person trying to cheat the system. It is the honest, careful person who did everything right for decades, who saved diligently, who trusted that someone would tell them when something changed, and who ends up handing over money they never had to lose, simply because nobody sat them down and explained which form to file and when. That is the most painful kind of mistake, because it is invisible until the bill arrives. There is no siren, no red flag, just a quiet number on a tax notice that should never have existed. So let's fix that today. I am going to walk you through 5 things tied to your IRA that most people over 65 get wrong or miss entirely, one at a time, in plain language, with exactly what you need to check or file for each one. Then I will give you a few bonus moves toward the end for anyone with a larger account, because those moves alone can be worth more than everything else on this list combined. And I want you to stay through to the end, because the 5th item is the one that trips up the most people every single year, and it is also the trap I promised you at the very start. The one where your actual birth year decides everything, and most people are using the wrong number without knowing it. Let's start with something brand new that almost nobody has adjusted to yet, which is exactly why it is being missed. For the 2025 and 2026 tax years, if you are 65 or older, there is a new bonus deduction of $6,000 sitting on top of your regular standard deduction. This is separate from anything related to your IRA directly, but it changes how much of your IRA withdrawals actually get taxed, and almost nobody connects those two dots. If you are married and both spouses are 65 or older, that is $12,000 combined, stacked on top of everything else. It phases out at higher incomes, starting around $75,000 for a single filer and $150,000 for a married couple. But for the vast majority of retirees pulling money out of a traditional IRA, this deduction quietly shrinks the tax bite on every dollar you withdraw. The action here takes 2 minutes. When your return is prepared, before you sign anything, confirm the extra senior deduction was applied and that your birth date was entered correctly, because that single field is what triggers it. Number 2 involves something most people assume is automatic and is not: your required minimum distribution age. Here is where the birth year trap starts to show its teeth. If you were born in 1951 through 1959, your required withdrawals from a traditional IRA begin at age 73. If you were born in 1960 or later, that age jumps to 75. Two neighbors, born a few years apart, can be legally required to start withdrawing at two completely different ages, and the IRS will not remind either one of them individually. The mistake I see constantly is someone assuming the rule they read about applies to them when it was actually written for a different birth year group. Get the age wrong in either direction, and you either withdraw too early and pay unnecessary tax, or worse, you withdraw too late and trigger a penalty for missing the deadline entirely. Who does this affect most? Anyone within 5 years of these thresholds right now, because the rules have shifted twice in the last several years, and a number that used to be true for your birth year may no longer be. The action is simple. Confirm your exact required beginning date with your account custodian using your specific birth year, not a general rule of thumb you heard from a friend or an old article. Number 3 is your qualified charitable distribution, and this is where retirees quietly overpay every year without realizing there was a better path. If you are 70 and a half or older, you are allowed to send money directly from your IRA to a qualified charity, and that amount does not count as taxable income at all. For 2026, you can send up to $108,000 this way. Here is what almost nobody realizes. If you are also subject to required withdrawals, a qualified charitable distribution can satisfy that requirement while completely avoiding the tax hit that a normal withdrawal would create. People who give to charity anyway often write a personal check after they have already withdrawn and been taxed on the money, which means they paid tax on funds they were going to give away regardless. Routing it directly from the IRA instead means that portion of your withdrawal never becomes taxable income in the first place. Who benefits most here? Anyone who already donates regularly, and anyone whose required withdrawal pushes them into a higher tax bracket than they would otherwise sit in. The action is one phone call to your custodian asking them to process a qualified charitable distribution directly to the organization, not to you. Number 4 is smaller in dollar terms for most people, but it still catches folks who are still working. If you are 65 and older and still employed, and your employer's retirement plan allows it, you may be able to delay your required withdrawals from that specific workplace account, though this exception typically does not apply to a traditional IRA you control on your own. This is the rule people confuse constantly, assuming that because they are still working, none of their accounts require withdrawals yet. Your IRA does not care whether you are employed. Only certain employer plans offer that delay, and only if you do not own more than 5% of the company. So if you are still working and juggling both an old IRA and a current workplace plan, you may be required to withdraw from one while legitimately delaying the other. Who does this affect most? Anyone past the standard required withdrawal age who is still drawing a paycheck. The action is a direct conversation with your plan administrator to confirm, in writing, whether the still working exception actually applies to your specific account. And that brings us to number 5, the one I told you to stick around for, because this is the birth year trap that costs people the most, and it is also the easiest one to avoid once you actually understand it. If you miss a required withdrawal, or you withdraw less than the amount required for your specific birth year, the penalty is 25% of the amount you should have taken out and did not. 25%. Not 25% of your account. 25% of the shortfall itself, gone, immediately. And here is the trap inside the trap. Because the required beginning age changed depending on whether you were born before or after 1960, a lot of people are calculating their required amount using an outdated formula they read somewhere years ago, before the rule shifted. They assume they know the number, they withdraw what feels right based on old information, and they come up short without ever realizing it. The penalty used to sit at 50% before it was reduced in recent years, and if you correct the mistake quickly, within a limited window, that 25% can sometimes be reduced further to 10%. But that relief is not automatic either. You have to notice the mistake, fix it, and file the correct paperwork explaining what happened. Nobody sends you a warning first. The action here is the most important one in this entire video. Every single year, before you take your withdrawal, confirm the exact required amount using your specific birth year and your account balance from the end of the prior year, ideally with your custodian or a tax professional walking through the actual calculation with you. Not a number you are recalling from memory or from a rule that may no longer apply to your birth year. Now, if you have built up a larger account over the years, let me give you a few bonus moves that most people never hear about, because for the right person, these can matter more than everything else on this list combined. The first is strategic partial Roth conversions in the years before your required withdrawals begin. Moving a portion of your traditional IRA into a Roth account during lower income years means that money grows and can eventually be withdrawn without ever triggering the tax hit that a traditional withdrawal would. The second is the enhanced catch-up contribution available to those between the ages of 60 and 63, which allows a noticeably larger additional contribution than the standard catch-up amount if you are still working and eligible to contribute. The third involves inherited IRAs. If you inherited an account from someone who was already required to take withdrawals, the rules governing how quickly you must empty that account are different and often stricter than the rules for your own personal IRA. And missing that distinction has cost families real money during a year that was already difficult enough. Let me bring this back to a real situation. I once worked with someone I will call a client of mine, born in 1959, who had done everything right for decades. She had a healthy IRA balance, she gave generously to her church every year, and she assumed she understood exactly when her required withdrawals needed to begin, because she had read an article years earlier that gave her a number. That number was based on an older version of the rule. When we sat down and recalculated using her actual birth year under the current requirement, we found she had waited a full year too long before her first withdrawal was due, and the amount she would have needed to correct it retroactively would have triggered a substantial penalty had we not caught it in time. We recalculated her correct required amount, filed the proper paperwork immediately, and routed a portion of that year's withdrawal directly to her church as a qualified charitable distribution, which meant that part of it was never taxed at all. Nothing about her life changed. She did not touch her lifestyle or her spending. The only thing that changed was that she stopped following an outdated rule that no longer applied to her and started following the one that actually did. That is the entire point of everything I have walked you through today. Understanding that a rule exists and correctly applying the current version of that rule to your specific birth year are two very different things, and the bridge between them is a form, a phone call, or a 5-minute conversation with your custodian. Nobody is going to build that bridge for you automatically. So here is exactly what I want you to do this week, and none of it costs you anything beyond a little time. First, confirm your exact required beginning date for withdrawals using your specific birth year, not a general rule you remember hearing. Second, if you give to charity, ask your custodian whether routing a portion of your required withdrawal as a qualified charitable distribution makes sense for you this year. And finally, if you are still working past the standard age, get written confirmation from your plan administrator about which of your accounts actually qualify for any delay and which do not. One last thing, and it matters. This is general education, not personal financial or tax advice, and these rules can shift depending on your specific accounts, your income, and changes in the law. Always confirm your own situation with a qualified tax professional or your account custodian before making any withdrawal decisions. And if this helped, you see something you had not considered, do one thing for me. Send it to someone you know who is approaching this stage, because catching this early is worth far more than fixing it after the fact. I will see you in the next one.